This is your Mortgage Rate Watch for Thursday, May the 12th, and I'm Keith Akada with the Mortgage Reel. Kind of a mixed bag of news today impacting the markets, and we just want to break it down really quickly. The 30-year bond auction just went off, and it received a D rating. Now, a D minus, this is not very good. It's really showing where investor sentiment is for long-term investments at this time. But here again, a lot of what Wall Street has already been talking about is the bond markets are overbought. And this is showing some pressures now against the mortgage rates. We'll see if we can maintain these levels, but we've been talking about a pullback that could be soon coming, and this could be the first signs of it. And we've been talking about how long can the rally last. We had 16 consecutive days, and then all of a sudden we started showing signs of weakness. Now, we did take a slight sell-off yesterday and really didn't impact the markets too much. However, looking at today with the weak bond auction results and then also a producer price index that came in hotter than expectations, kind of spooked the market as far as how companies will react as far as pricing to the consumer. With them facing higher costs and unable to pass it on to consumers, that's going to mean less profitability for them, or will they eventually start to increase the price to the consumer? Now, the other interesting thing happening right now is obviously what's going on with oil, with the 5 major oil leaders, company CEOs being in Washington, D.C., talking to Congress about what they feel about these tax cuts. And interestingly enough, we're going to talk about in just a moment what one of them has said about oil costs going into the late second half of this year. The job market remains sluggish as the numbers that came out were 434,000 above the expectations of 423,000. You know, Wall Street has talked about quite a bit the emotional and psychological barrier of the 400,000 to show that the job market is starting to improve and not being as sluggish. But here again, just as the comments we made about the small business owners and everything going on with the increasing cost of oil and how that impacts everything, it's not coming as a surprise to the marketplace that jobless claims are slightly higher. And this is mainly because consumers just aren't out there spending yet because they're in fear of what's going to happen with oil costs. Very interesting comment came out this morning from the Exxon Mobil chairman, which he stated that oil should be $60 to $70 per barrel. Now, comparatively speaking, oil is currently above $90 a barrel. So where does this put everything? If the dollar is getting stronger and oil does come down in the second half of the year, what they've been talking about already is that housing is looking to make its recovery, at least stabilizing and slow recovery back in the fourth quarter. Well, if that is the case, then everything is kind of aligning within the stars at the moment. You have a stronger dollar. All of a sudden, when oil shows signs of weakness coming from the ExxonMobil chairman, what happens to silver and gold? They all of a sudden showed weakness this morning, and they showed that they were possibly selling off. Now, on the flip side of that, look at everything in the economy that's tied to oil right now. If you back off the cost of oil, that means that small business owners are going to start to hire again because the cost of everything is going to come down. And then the biggest thing happens, consumer sentiment comes back because now the consumers aren't so sticker shocked by the price at the gas pumps. Overall, the costs of everything start to come down. Consumers get out there spending more, then what's going to happen? Companies are going to start to hire, overall increasing the sentiment of the initial jobless claims in the employment market. Now, that's going to be a slow growth in return. But here's the main thing that's probably going to happen that's tying into what they're already forecasting for the economy and overall housing market recovery. If they are saying the second half, and if this whole thing with oil is going to come down, the first thing that may pop, not a huge jump, but that may pop, is the housing market. Why? Because if you have stronger confidence in jobs, stronger confidence that the prices are going to remain stable within a reasonable reason, and then all of a sudden if interest rates start to move, because now you're talking about an improving economy and you can't deny interest rates are going to move higher, the first thing that smart investors and buyers are going to do is start buying again in the housing market. Now, that's very interesting. This all ties again with what every single economist is really saying right now about the third and fourth quarter of this year and the housing recovery. Make sure to leave any comments, feedback, or questions below. We'll make sure from Team Mortgage Reel to get back and answer those as quickly as possible. We have a special request we'd like to make before you leave, and hopefully you've enjoyed today's clip. Make sure to check on the home page, click on the banner at How to Beat the Banks, and that'll take you directly to our Facebook fan page. We definitely put out more and more information and to create transparency in the financing process of home ownership. We're big advocates of home ownership, obviously, but we want to make sure it's as easy as possible to understand what's impacting and the education necessary for home ownership today. And when you're visiting us on Facebook, make sure to like us when you're there. Thanks for tuning in to Your Mortgage Rate Watch. We'll be back with more news impacting your largest investment, your home.